Earnings season is finally here again. Of course, this also means that there are potentially companies giving out dividends during this period of time to shareholders holding their company shares. So in this video, I will be doing a short summary of their respective results on a few companies that will be announcing their results in this coming week. You can also leave a comment on what additional things that you would see for the respective companies. On the 24th of July, there will be Mapletree Logistics Trust, Fraser Centrepoint Trust, and Digital Core US Reit. The next day, Mapletree Industrial Trust will announce their result. For the last day, we will have Keppel DC Reit, Keppel Infrastructure Trust, and Parkway Life Reit. So let us go on to the first REIT, and that is Mapletree Logistics Trust. Mapletree Logistics Trust has always been one of the more reliable REIT that is able to manage their dividend payments well. They are a pure logistic REIT where assets are diversified into 9 different countries, with majority of the assets mainly in Singapore, Hong Kong, and China. Although logistics is an in-demand industry, one factor that is pulling MLT down is the properties in China. So the focus will be on the performance of the China properties to see on their occupancy and the rental reversions. Moreover, in the AGM, investors have asked regarding the 13.2% lease in their China properties that will be expiring. Seems like the situation there is not good, with negative rental reversions expected. So because China contributes 20% of their revenue, it will definitely impact MLT overall income as the rental reversions comes in lower. Of course, there might be surprises if the new properties are able to contribute higher income. So we will see how it works. At the current share price, it's priced at 6.5% dividend yield. The next REIT that I would like to talk about is Fraser Centrepoint Trust. Fraser Centrepoint Trust is a very solid REIT because they are a REIT with properties purely in Singapore and the retail sector. What makes this so unique is that Singapore is a highly dense country. Therefore, shopper traffic tends to be higher in most of the malls as compared to overseas retail malls. The part that I would like to focus on is whether they can maintain the high rental reversions similar to their recent results. Another pointer to focus on is the changes in the shopper traffic and the tenant sales. With the post-COVID situation stabilizing, shopper traffic might normalize unless the recent inflow of tourists are able to make up for the differences. The debts is also something to focus on, with the cost of debt being at such a high level. But overall, they are doing fine, which can be seen from their share price as well. At the current share price, it's currently giving a dividend yield of around 5.5%. The next REIT I would like to talk about is Digital Core Reit. Digital Core Reit is a REIT which focuses purely on overseas data centers. Previously, they only had data centers purely in US, but recently they have expanded to Germany and Osaka. Recently, they have also made interesting move by doing share buybacks, unlike most of the REITs. They have also mentioned that the DPU accretive will be expected from their additional investment and share buybacks. We will see in this coming quarter whether these actions are able to help improve their DPU. The main risk for Digital Core Reit is the high concentration of tenants contributing certain income. Now, why is this risky? It's because in the event if one of the tenants defaults, they will lose this amount of income. So far, it seems like their top tenants is not a concern except for the third tenant, which has a unrated credit ratings. So please take note of this if you are an investor for Digital Core Reit. Good thing is that their profit came in higher at 15.5% year over year, even though their distributable income came in slightly lower at 2.4%. Finance expenses is the main issue, similar to all REITs. Good thing is that they do not have much debts to refinance for financial year of 24 and financial year of 25. So we will expect debt-wise to be quite stable. At their current share price, the dividend yield is expected to be about 6.5%. So we will see if they might give us a surprisingly positive result with the new assets. The next REIT will be Mapletree Industrial Trust. MIT is a REIT that I've extensively covered in my previous videos. They have lots of different assets with data centers being their main focus. Unlike digital Core Reit, they have a much more diversified tenant with less dependent on one tenant for their income. For the occupancy and rental reversion, hopefully we will continue to see the good upward trend so that MIT's dividend will increase. Like I said in my previous video, even though DPU came in lower at 1% year over year, it was a big win for MIT management. With the new contributions from Kallang Wei and Osaka DCs, which is their new assets, they are able to sustain the dividend quarter over quarter without the distributions from the divestment gains. In my previous analysis, my concern was that without these divestment gains, MIT dividend might come in lower. But the previous quarter, they have proven me wrong and came in stronger. I'm optimistic that with the borrowing costs stabilizing and the Kallang Wave assets continue to improve in occupancy, we might see increase in their dividends. At the current share price, its dividend yield is expected to be around 5.8%. Let's go on to the next REIT, and that is Keppel DC Reit. Keppel DC Reit is a pure data center REIT that have properties in various countries. However, similar to MLT or even worse, their China assets is facing default issues where tenant is not paying. However, even until now, there seems to be no conclusion to this issue. Without the 7% assets income, this will definitely be the one that will continue to drag Keppel DC Reit's dividend down. On the bright side, they have actually started purchasing data centers in Japan, which is always welcoming considering the low interest rate in Japan. At the current rate, their dividends will be expected to drop year over year because of the Guangdong data centers in China. Good thing is that Keppel DC Reit share price is quite resilient considering the expected drop in the dividend. At the current share price, I feel that the dividend yield might be in the range of 4.5% to 4.7% if we account for the possibility drop in the dividend. We'll see in this upcoming result what will be the expected dividend. The next REIT that I would like to talk about is Keppel Infrastructure Trust. They are a business REIT which gives reliable dividend and focuses purely on infrastructure investments. My focus on this quarter will be on their distributable income performances. This is very important as it will determine how much dividend or dividend payout ratio they will be giving. Hopefully, this quarter we will see the wind farm and Philippine storage start contributing back with their one-off expenses being settled. Based on historical trend, as long as they have a distributable income of 95 million and above for the 2 quarters, their dividend payout ratio will not be more than 100%. With the recent purchase of Ventura Motors, it is expected that the DPU should increase by 3.4%. Interestingly, this was assuming there was equity fundraising, which means that this 3.4 is based on the diluted share amount. So, I will look forward to seeing the debt structure that they have taken and potentially how much more DPU will increase due to the different path taken by the management to raise capital. This is a big purchase as it will increase Keppel Infrastructure Trust assets under management by 7% from 8.1 billion to 8.7 billion. However, it's important to see the performances of the assets, which we should see them start contributing this coming quarter. Because of the low share price, rather than opting for issuing new shares to raise cash for the Ventura acquisition, they have went ahead with fully purchased with loans. So it will be interesting to see the updated debt sheet in this coming quarter. At the current share price, it's giving a dividend yield of around 8% at semi-annual dividend basis. Next, let's talk about one of the most consistent REIT, and that is Parkway Life Reit. Parkway Life Reit has been one of the consistent REIT in managing their properties well that allows them to constantly increase their DPU. How Parkway Life Reit is able to increase its dividend constantly is through the annual step up in the rental payments from the tenant. and that is the Parkway Hospital Singapore. Based on the rental renewal in financial year of 2026, it will seem that there is a big increase, and this will definitely be good for shareholders because the higher the rental income, this means that there's more income for the REIT to distribute as dividends. The management has also been doing very well in ensuring that their cost of debt is not high by constantly issuing debts or notes in Japan yen. With the weak currency and low interest rate in Japan, it's expected that these new notes have a much cheaper interest payment compared to other countries' debts. This allows their gearing ratio to be decent at 36.4% with cost of debt of just 1.27%. With the good management of their finance costs, it allows their income to rise faster than the rise in the finance costs. That is why for the financial year of 2023, they were able to report higher DPU year over year. However, at the current share price, it's not cheap as the dividend yield is priced at 4%. Of course, this is also because investors price them as a much safer in terms of both dividends and REIT. That's why they are priced at a more expensive valuation. I hope this video gives a good overview of the few good REITs that will be reporting in this coming REIT. Thank you so much for watching. I hope this video is very informative for you. You can also watch my other videos, which is the guide for REITs if you are new to investing in REITs, or if you are interested in investing in banks as dividends, you can watch this video here. Thank you, and I'll see you in the next video.